The S&P 500 just set a new record high. The Nasdaq is soaring. And right now, millions of investors are walking straight into a trap they don't see coming. In the next 8 minutes, I'm going to show you the warning signs nobody's talking about, the price levels you have to watch, and exactly what happens to your portfolio when the market finally snaps. Stay with me. This one matters. Hey, I'm here, and on this channel, we break down the market before it moves, not after. If you're here for real analysis and not cheerleading, this is the place. Today's video is about the invisible pressure building under the surface of this rally. We've gone up nearly $2 trillion in 2 months on the back of AI enthusiasm. But underneath that headline, the cracks are already showing. By the end of this video, you'll know why the pullback we saw this week is a warning sign, not the bottom. What triggered the sell-off in semiconductors and AI stocks? Which price levels matter for the next 48 hours? How to position yourself if the market rolls over. Let's go. First, the setup. We hit all-time highs about a week ago. S&P 500 closing above 7,560. Nasdaq north of 26,900. Every financial news outlet was celebrating. Fed pivot narratives, AI boom stories. This time is different, right? Then this happened. Wednesday and Thursday, we got hit with a triple threat. Number one, geopolitical escalation. The US and Iran tensions reignited. You saw oil spike. West Texas Intermediate moved from the mid-80s past $96 a barrel in days. When oil jumps like that, it's a red flag for everything because higher energy costs equals higher input costs equals lower profit margins across the economy. Number two, labor market crack. Initial jobless claims just posted their highest level since early February. That's not a small move. That's your warning light on the dashboard. When employment starts rolling over before the Fed has even cut rates, that's a signal that real economic pressure is building. Number three, and this is the killer, earnings reality check. Broadcom, one of the biggest beneficiaries of the AI infrastructure boom, reported results. Revenue missed expectations, missed badly. Stock got absolutely demolished, down 15% in one session. And that triggered the rotation we all saw coming. Out of tech, out of semiconductors, out of the high growth AI narrative, and into banks, retail, defensive plays. Here's what matters. That rotation isn't healthy profit taking. It's institutional money taking chips off the table and heading for the exits. Let's talk about what just happened in the AI trade because this is critical to understanding whether we've hit a real top or if this is just a speed bump. For the last 8 weeks, there's been one trade in the market. Buy AI, buy semiconductors, buy Nvidia. Full stop. Everything else was ignored. The Magnificent 7 tech stocks carried the entire market higher. We're talking about a rally where 80% of gains came from like 10 stocks. That's not a healthy market. Now, I want to be crystal clear. I'm not saying AI is dead. I'm not saying the AI trade is over forever. What I'm saying is we've gotten ahead of the actual earnings growth coming from these businesses. Think about it this way. Broadcom sells the infrastructure that goes into data centers. They sell the chips that support the models. If they're missing revenue targets, that's telling you something about the actual demand for AI build out right now. That's not bullish. And when one company in a sector that has driven an entire market rally misses earnings, everyone holding that stock and stocks like it ask the same question: how much more is baked into my position? The answer for most people is way too much, so they sell. And when institutional money starts selling in an overheated sector, it doesn't stop at Broadcom. It cascades. VanEck Semiconductor, ETF, down over 2%. ARM Holdings down 6%. Micron off 7.7%. Nvidia weighed by association. But, and this is where it gets dangerous, the Dow was up, banks were EUP. JP Morgan up 2.7%. United Health nearly 6%. Walmart up 1.4%. So you had this happening. Rotation into value stocks, rotation out of growth, flight to safety into banks and retail, oil climbing, treasury yields holding firm. That's the definition of a risk-off environment disguised as normal trading. Now watch what happens next. When one sector gets hit this hard and the rest of the market shows weakness, traders start asking, are the record highs at risk? That question starts getting asked louder with every piece of bad data. And remember, we've got jobless claims at a 5-month high. That's the latest data point. More of that coming, and you're going to see capitulation. Okay, Practical levels you need to be watching right now. S&P 500. Resistance. 7,600 level is where we were a week ago. That's not holding right now. Critical support. 7,450 is the level. Break below that on high volume and the market's confirming that the top is in. Further downside, if we break 7,450, the next meaningful support is back at 7,350. Nasdaq. Resistance. 27,000. That's the psychological level. We were flirting with it at all-time highs. Support. 26,500 is where you want to be watching. Break that and tech is showing serious weakness. If that breaks, 26,000 is the next level. That's where you're back to pre-AI boom territory. For individual stocks, I'm watching Nvidia. This is the bellwether. Nvidia holds the market on its shoulders right now. We need to see it holding above $130. Below that, the narrative flips from growth stock to overheated. Watch for a breakdown below $125. That's a panic signal. Broadcom already down 15%. Technical breakdown, not a buy yet. Wait for it to find a floor around $155 before you even think about catching this knife. Semiconductor ETF SMH, down 2% already. Next stop, if weakness continues, $95. Right now, sitting around $105. That $95 level is a line in the sand. JP Morgan, the bank that's benefiting from the rotation, support at $215. If that holds, banks are the winners. If it breaks, rotation is done and panic sells everything. Here's the pattern to watch. If we get another 1 to 2% down day in the S&P 500 combined with another surge in jobless claims or more geopolitical escalation, you're looking at a 3 to 5% pullback minimum before support holds. And that's assuming nothing else breaks. Right now, the market is one bad headline away from a 5 to 7% decline. That sounds dramatic, but when you're sitting at all-time highs on the back of a narrow rally, that's not extreme. That's just mean reversion. So what's the actual move here? If you're fully in the market expecting the rally to continue, be careful. We have deteriorating employment data, geopolitical risk at the high end of the range, a beloved sector, AI/tech, showing a crack, record valuations on the assumption of AI earnings that are still theoretical. That's not a recipe for higher. If you're sitting on profits from the tech run-up, this is the window to trim. Get some chips off the table. Take profits on the winners. You don't need to sell everything, but lighten up. If you're in cash or defensive positions, wait. This pullback could easily go another 5% before support holds. No rush to buy the dip at these levels. If this is your first time watching and you're newer to investing, remember this moment. Remember how the market looks before it reverses. Remember the warning signs. Sector that drove the rally starts cracking. Labor market deteriorates. Valuations compress. Money rotates to safety. This is the setup, the trap I warned you about. It doesn't always mean the market crashes, but it means you need to respect the risk, because tomorrow might not be down, but the margin of safety is gone. Here's what I need you to do. 1. Hit the subscribe button. You need this analysis before the market moves, not after. 2. Turn on notifications. The next major sell-off could happen in the next 24 to 48 hours. 3. Write down those price levels in your notebook or trading platform. These are the levels that matter. 4. If you found this valuable, hit that like button. I'm reading the market so you don't have to. And finally, this is not financial advice. I'm not a financial advisor. This is educational analysis. You need to do your own research, check your risk tolerance, and make your own decisions about your portfolio. If you're making big moves, talk to a qualified financial advisor. What's your take? Do you think the market's got more upside, or are we rolling over? Drop it in the comments. Let's debate it. I'm back with more analysis tomorrow. Until then, stay focused, stay disciplined, and don't panic into the trap. See you next video.